Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Deere Company, ticker DE. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. This company has a market cap of $102 billion, enterprise value $129 billion, so we can see about $27 billion in net debt leverage on this business. That's quite a significant amount, but it's only about 20% of their equity. Industry is in the machinery industry. Deere Company operate in four segments: production and precision agriculture, small agriculture, turf construction and forestry, and financial services. So they manufacture and distribute their equipment. So they provide mid-sized tractors, cotton pickers, strippers. They have tractors, loaders. They also have backhoe loaders, crawlers. And then they have a segment that finances sales and leases, agriculture and various equipment. So they have both the financing side and the production side. This tends to be a pretty decent business. I would guess that the brand is certainly recognizable. I've heard of Deere. And so anytime you have a recognizable brand, that can usually help them with the gross profit margins. But gross profit margins don't seem to be super high. So we have at 28%. So we'll see how it is as we look at more of the numbers. Now, the first thing that's easily noticeable on my return on invested capital chart is the cyclicality of this business. Up and down, up and down, up and down. So you can see that they suffered during the 2009 recession and had a downward. They had some downward time in kind of like a 2015, 2016, almost a recession type performance, similar to 2009. And then they're doing well and back up again 2021. That's the first thing I noticed is there is cyclicality in this business, but during some parts they do have some stability year to year, but it is very cyclical over the course of a 20-year period. You have 2-3 full cycles maybe, or 2.5 cycles over a 20-year period. So you're about a 7-8 year cycle type business. One other thing that I noticed is you have 20 straight years of profitability. That tends to be a positive sign for their performance. But then the downside of their performance is, despite having no losses over the last 20 years, they're really averaging around a 5% return on invested capital. They never get above 10%, and really 10% is that minimum threshold I want to see for a long-term investment holding. I want to own stocks with 10% plus returns on invested capital, and Deere's is just a little low. Now, I did mention they have a lot of leverage, and so what you can do is, even if you have low returns on invested capital, if you leverage it up right with debt, you can get higher returns on equity, and we do see that here. So in our statistics here, we see that return on equity is 27%, while the return on invested capital is 5%. So that's actually a really nice setup for leverage. So they're turning a 5% return on invested capital and 27% return on equity. That can be a driver for really good equity returns, even if on an enterprise value basis, it doesn't show up to be the same. So mixed results there, positive in terms of long-term history. I don't like the cyclicality, but in terms of cyclical businesses, that's not a terrible result. Now, PE ratio of 16. I like to buy stocks with a PE of 15 or less. So this is maybe on the fair value range to overvalued range. If we said fair values, 13 to 17, and you're right at the top end of that, maybe you're fair valued, slightly overvalued on a first look basis for this valuation. But the 10-year CAGRs tell us a little bit more information. We see that the revenue number is 3% growth, but you have 18% and 11% free cash flow and EPS growth. These are the numbers that are really going to drive your long-term results. However, the revenue growth is really the baseline for what you can expect. You can't expect EPS growth and free cash flow growth to outpace revenue growth permanently. You can only expect that over shorter periods of time. So really the revenue growth is going to be your baseline. So you think, okay, maybe I have an earnings yield of 6%, revenue growth of 3%, that's going to trend towards like 9% rate of returns. And so what's really happening is, yes, you have a high return on equity, but you're not able to drive that into very fast growth, presumably because they already own a significant amount of the market. So it's going to be a big, difficult measure to reach these same numbers, but we'll see as we dive in further. Gross profit margins pretty stable in the 28 to 29% range. You have a pretty good year here in 2021. But otherwise pretty stable gross profit margins. The operating margin has a little bit more ups and downs. You can see the EPS growth has these years, sometimes 3 years in a row of declines. Look at that. 2013, they made $9 per share. Then it went down in 2014, down in 2015, and down in 2016. You really don't like to see that. Again, that's that cyclicality here, where you start up here at this peak and you face 3 straight years of declines. That makes it very hard for an investor to predict the future for their investments. For instance, I can't simply value this business off this $19 per share in EPS, which is what gives me the 16. Because what happens is, could I have 3 more years of declines? This was a 50% type decline in EPS from 2013 to 2016. So a 50% decline from 2021 could take my earnings from $19 per share to like $9.50, or call it $10 per share. And now we're trading at a PE of 34, and we're extremely overvalued. So this is one of the difficulties with cyclical businesses. Yes, looks like we could be buying at a cyclical top, which is always a dangerous time to buy. So it's something to be aware of here. But if you just look at the surface of the numbers, it looks pretty good. I mean, you've gone from $7.63, $18.99. That's almost a triple, 2.5 times growth over the course of a decade. You repeat that over a long period of time, you're going to get very, very satisfactory returns as an investor. They're also paying a dividend, and it's good that because that means that dividend is going to provide you a little bit of a bump of extra return. But you can see that at the current price, $3.61, you're really only getting about a 1% dividend yield. So it's not a significant part. It's just that 1% extra boost. So it takes you up from a 6% earnings yield, 3% growth plus 1% dividend. Now you're at around a 10% rate of return. It's not terrible. That's respectable. But that looks like your upside scenario. That looks like your long-term upside scenarios. You could have worse performance, again, if you have collapses in earnings here. So you have to be very, very careful, because you could be getting somewhere closer to a 5% rate of return, which is trending towards the bottom line with your return on invested capital. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. Your likes and your subscriptions help tell YouTube you're enjoying my content, and that helps me to grow the show. So I really appreciate that. Let's go to the income statement. Now, one thing is interesting is they've held pretty steady, static SG&A over the course of a decade, and that tends to trend in line that besides the most recent year, they've had fairly flat revenue. I mean, from $35 billion in 2012 and $35 billion in 2020, basically no growth over the course of the decade. That's actually quite poor for a 9-year period with no growth. But you can see that they are managing the business well. They're keeping capital in check, keeping SG&A in line with that. Research and development grown a little bit, but they're managing their business very well. You like to see that on their operating expenses, because sometimes you have these businesses where gross profit doesn't grow, just like it didn't from 2012 to 2020, and yet they grow their operating expenses so much that operating profits are really, really hit. But they've managed that quite well. You see a little bit of a decline, 3.9 billion, 4.7 billion, but it's not catastrophic, so that's actually pretty good. Now, what's interesting here, of course, if you again look at that same 2012 period, you see $3 billion in net income to 2.7 billion, $3 billion in net income 2019, 2020. So they're not actually growing much over the course of the decade. But 2021 was so massively an outlier that you get these big $19, $20 numbers. This is not what I would consider sustainable. I'd be very, very concerned extrapolating these numbers. And to me, this number alone is going to push me away from buying the stock, because now I'm really worried about valuation, because there's not a single year besides 2019 where you're over $10 a share, and you spend most of the decade under $10 a share. Now all of a sudden we're going to assume that $20 a share is normal. It doesn't look like that to me. Earning in the $2 to $3 billion range seems to be what they're earning. So to extrapolate $6 billion can get you in trouble. Now, what you can see the growth on is they are dedicating money to share buybacks. 400 million shares outstanding to begin, 315. So they've retired over 20% of their shares outstanding over the course of the decade. That gives you an additional 2% boost to your potential return. So again, 6% earnings yield, 3% growth, 1% dividend, 2% boost. That's where you get to the upsides, maybe 11, 12% now. So you have an upside case of 11, 12% returns, but it's all based upon maintaining these, really high growth rates. Now, on a balance sheet perspective, let's see. So you have grown your accounts receivable by 50% over the course of the decade. That's a little bit concerning. I mean, think about this. Your net income's basically flat, but your total current assets are up 50%. Your PP&E is up double. You've gone from $6.5 billion to $13 billion. So your returns on your assets are getting worse and worse and worse, because you're not actually getting those higher rates of return. You're not actually getting higher net income. And it's a major concern for you as a potential shareholder or as a current shareholder. In addition, you've doubled your debt. Look, you've gone from $16 billion in debt to $32 billion in debt. That's not going to be repeatable. You can't take this to $64 billion in debt over the course of the next decade and expect to still be doing well. So I have major, major concerns here with the future sustainability of these EPS. Again, if you could maintain 11% EPS growth for the next decade, that would be really attractive. But I think it's likely to draw back down closer to the return on invested capital, closer to your revenue growth rate. So your future returns are going to be closer to 3%, 5%, 7% instead of what we saw over the last decade. And that's starting to push me away from wanting to be in the business. But maybe there's something else that's interesting on the cash flow statement. You do see that their investments in PP&E have gone down a little bit over the last 2 years. Maybe that's COVID, but something to be aware of. They did make a big acquisition in 2018, $5 billion, but it's not huge compared to their business size. But you can see, of course, steady buybacks. That's always nice to see. And these buybacks are always higher than the stock-based compensation. So you are getting that dilution, not dilution, but the reduction in shares outstanding over time. I would really like to see that as a shareholder. So that's a good sign as well. Yeah, to me, the crux for Deere is they're probably an average business. An average business is going to be cyclical. You'd see the cycles. They're slightly on the above average side simply because they never have a year of losses. So if you're going to cycle but you never have a loss, that's going to make you slightly on the above average range. But you're in the average above average range. You're paying an above average price. But the real problem with valuation for Deere today is you're extrapolating this PE ratio over a very high-end earnings that probably isn't repeatable. So if we just say their actual earnings power is $10 per share, then you're trading at $34 of PE. So you could be on a forward PE of $34 and then you're paying an extremely high price. So I'd want to be a lot lower in PE than even 16 for a company like Deere because they're cyclical, because they're not very predictable, and because we're buying at a cyclical top potentially. That's what it looks like historically, is this is a cyclical top. So you'd want to be very, very careful before investing in Deere Company. And so for me, I'm going to pass. It's not going to go on my watch list. I'm not really interested in cyclical companies. And really, they don't have a single year in the last 20 years with a return on invested capital above 10%. So that's discouraging for me as well. If you enjoy this content, please hit that like button. Don't forget to subscribe. I'm uploading new content Monday, Wednesday, Friday. Each and every week we are covering new stocks, and I already have 130 S&P 500 stocks covered in the playlist you're going to see linked above. And so I encourage you to check out that playlist where I've already covered the first 130 companies in the S&P 500, starting with A. We're going all the way to Z. I hope you will join me with that. If you would like to do this type of analysis yourself, if you want to use the software I use to do my stock analysis, it is quickfs.net, and I have a link in the description below. It's the first link in the description is my affiliate link. You check out with my affiliate link, you can sign up for either a paid or a free account. Either way, clicking my link doesn't change the price to you. It just means that if you sign up, then I would get a commission. And so if you'd like to support the YouTube channel, consider signing up through my affiliate link. Thank you for listening, and until next time, stop paying fees, start building wealth.